Okay, welcome back, viewers. We are proceeding our series on economic environment, paper 3 CPA, level 1. And we are going to look at commercial banks or commercial banking. Commercial bank is a financial intermediary which collects surplus funds from the public, that is, it accepts deposit, safeguard that deposit, and make them available to true owners on demand or when they need it. What you have to understand with these commercial banks, first of all, these are banking financial intermediaries. They are under the operation of central bank. They obtain money from the central bank as the lender of last resort. And the other money, they get it from the public by accepting deposits. People open up accounts and they deposit in their money, either fixed deposit or salary, whatever. What the banker does is to safeguard that deposit they have received, and they make it available to their owners when they need it. So let's look at some of the functions of commercial banks. They accept deposits and safeguard them on behalf of the customers through opening up an account with the bank. Said they keep the deposits of the customers. The other one, they give loans and overdrafts to customers like short-term loans, long-term loans, and others. An overdraft is the money that you withdrew from the account that is more than what you had there. If you, let's say you had 2 million in your account and you went to the bank and withdrew 3 million, it means that 1 million is something, the money which is over and above the amount or the account balance. It means they have given you a loan. It's like a loan, and it is a short-term loan. They exchange currencies for their customers, hence aiding international trade. They do exchange rates. They change currencies for different customers. The other one is they keep articles and documents, valuable articles and documents in safe custody on behalf of the clients. They keep land titles, wills, and others. They facilitate easy and quick payment of debts on behalf of the customers through the use of checks and standing orders. When you can write to the bank and you give them a standing order that you'll be paying my monthly subscription, let's say to DSTV, they will be making those monthly subscription. So it means they help you pay the debts on time. The other one is they give advice and other technical, and they offer technical services to customers on businesses and money. When you go to apply for the money, they automatically they give you their view on what you are going to be doing with the money, and they see the viability. They try to counsel and guide you on how you can be able to benefit from the money you are borrowing from them. The last one, they participate in the implementation of policies. We said it's these commercial banks that the central bank uses to implement the monetary policies, like the open market operations, the banker rate, all of those that are used to control inflation and money supply, they are done by commercial banks. So we can try to look at the credit creation. We try to look at the credit creation. I told you this is a system that is within the commercial banks, and this is how they get the money that they are giving to the public, and that's how they get paid also. And this is what we are going to be looking at, and we be able to understand how do these banks be able to keep our money we give to them. They safeguard it and they keep it available as and when we need it. And on top of that, they also be able to get a profit and be able to run those, be able to provide those services to us. We are saying that credit creation is the process of creating new demand deposits through lending out excess funds to credit-worthy customers by commercial banks through the use of checks. We are using checks when you are depositing the money. So it is the process of creating new demand deposits. Demand deposits, those are the different customers that are putting in money into the account, either by fixed account, savings account, and others. This is the process of creating new demand deposits through lending out excess funds to credit-worthy customers by commercial banks by the use of checks. This is what happens. If the commercial banks, if these commercial banks, they lend out money to, if let's say they give you a loan of 10 million, that 10 million loan they have given you, you will deposit that money into the account that you have opened with them. When you deposit that money, they will keep some money that they tell you that this money is supposed to be maintained in the bank. That is the cash reserve. And that money that is kept in the bank as cash reserve, it will be there. Then you can utilize the other one. We are going to look at the procedure and how we'll be able to compute everything. But let's look at a credit multiplier. This credit multiplier is the one that facilitates or that quickens or that increases the first deposit we've received. This is the number of times the initial deposit multiplies itself to give a final banker deposit. What do we mean by this? Is that these, we are saying that these are the number of times the initial deposit multiplies itself to give a final banker deposits. And we are saying that the computations here, they are total final deposit over the total initial deposit. Or someone can say it is 1 over cash ratios. And we are saying we have a note that when the cash ratio is increasing, then the credit multiplier reduces. And a reduction in the cash ratio leads to an increase in the multiplier on the credit multiplier effect. We're going to look at this because here, even if I explain, not understand, it means when you're doing the computations. Okay, let's go to the process of creating, of credit creation by commercial banks. How do they create credit? We are going to take these assumptions and we try to look at how we are going to be able to get this. Okay, let's go ahead. We are saying that the first step is, we are just making assumptions because we don't have the, like without just using assumptions. We assume one commercial bank which lends to several individuals. Of course, that's how it is. That's how it is. It keeps on lending to several people. Then the next assumption is that we assume that the cash ratio to be fixed at 20%. That's the money that we're supposed to remain with in cash form. Money that we are supposed to be remaining with, the amount that is deposited to be the amount that is deposited to be 10,000, sorry, 1,000 shillings. And we are saying that we assume also that the several individuals, that is A1 to up to AN, are able and willing to borrow money from the bank, and the bank is also willing to lend to them. That's what happens. If at all the bank is willing to give them the money, and they are also willing to take the money. Okay. Here we are saying that the process of credit creation is illustrated as below. From the table, this table, we have a table here. These are the people from A up to N. Then we have the deposits. These are the new demand deposits that are going to be created. This is the initial deposit that this person deposited into the bank, which is 1,000. And we say the cash ratio or the cash reserve is 20%. The 20% of this, it will give you 200,000. Sorry, 200. Then the new loan will be 800. Because when you deduct this minus this, you get 800. So we are seeing that from the table above, this table, person A deposits 1,000 in the bank. This is the 1,000. The bank keeps 20% as cash reserve. That 20% was giving us 200, and lent out the 800. This is, let's say we are assuming that you have a fixed account and someone has deposited, and the person has deposited 1,000. When the person deposits 1,000, we keep 20% as cash reserve. Then that amount that is remaining, it will be 800. That 800 is the one that is going to be given out to another person, because when you're depositing the money into the bank, what they do is that they make sure that that money is withdrawn at a certain period or at a certain date. You may say that I'm saving for, let's say, 1 year. You deposit the 1,000 and it's supposed to be there for 1 year. So what they do, the central bank requires them to keep 20%. So it will be that 20% of the 1,000 that you've deposited, you remain with the 800. And that 800 will be the one that will be given to another person. You're seeing that this 800 is the one we had that we remained with on the amount that was deposited. So this 800 is lent out to the person, to the second person, and this is the 800. And this is what you're seeing, that 20% as cash reserve and lent out the 80% in form of check to person A2. And now what happens next is that even on this 800, we shall keep 20%. That 20% will give us 160. This 160, will be the one that will be kept in cash reserve. Then when you deduct this minus this, you remain with the 640. This 640 will be now the new loan. This amount will be lent to the next person. So that one is, the whole of that is done until this figure is complete. Until it is complete, because when you try to sum up, it will give you 5,000. When this one is complete, the whole of this, because now we shall be bringing this to this side. Until that figure is complete, we'll keep doing it like that. Then if you want to use the method, you can just go by this. The total, to get the total deposit created, it will be the 1,000, that is the initial deposit. This is the formula. Initial deposit times 1 over cash ratio. That cash ratio was given to us in percentage. So it will be 1,000 times 1/20%, which will give us 5,000. And this 5,000 is this. It is coming as a result of adding this 1,000 plus this 5 until you complete that. Hope it's clear now. That's how we create. But what happens? There are some scenarios. When we have kept this as cash reserve, what happens is that if you have so many customers, what happens is that what if this person we've given this 800 doesn't deposit the same checking into our bank? Then the process has to stop. That's the problem. So we are going to look at the limitations of this credit creation. That if this person will give this, we lent out this 800 and the person doesn't deposit that money into our bank, then it means we are losing money. The process cannot continue. Then there is also another scenario whereby this money we've kept here, it is going to accumulate and we'll be having a lot of money. That's liquidity. It's going to be a lot of money. It will give us problems. In terms of security, it will make us to make sure that we'll be guarding everything. Then, in the process of doing this, we are going also to look at the profit component. How are we going to be getting our profit? Because at the end of the day, we are supposed to make profit. We are supposed to make profit and we are supposed to make clients money available when they want it. So we are going to, those are the dilemmas we are going to look at. There are three. The one in terms of security, the other one in terms of profitability, and the other one in terms of liquidity. That is the demand for money or liquidity preference. Okay, let's look at some of the limitations. What are some of the factors that may limit the creation of credit? One is use of restrictive monetary policies by central bank. When the central bank uses restrictive monetary policies and in terms of these restrictive monetary policies, we have by increasing the bank rate, by increasing the direct taxes, you are reducing the money in circulation, first of all. And when you reduce money in circulation, people will not be having money to deposit into the bank. So when they don't have money to deposit into the bank, then we expect that those people, they are not going to be able to do the credit creation. Then the other one will have presence of inadequate credit-worthy borrowers. People, you can't even trust them. When you give them money, people, they may just disappear with the money. And why are we having them is that because they cannot even afford the collateral securities, they don't have. So when they can't take the money, then we are going to be remaining with the money for nothing. Because if they deposit the money, and at the end of the day, we are supposed to pay interest on those people who have made their fixed deposits, and you have not used the money, then we are not going to be making business. So if people are not having collateral securities, it means they will not borrow, because banks, they are advised in terms of security. That is the dilemma. Security dilemma. They are advised to get securities from clients, so that by end default, people fail to pay, they can get the money back. Okay. The other one, the theory assumes that the borrowers deposit checks they got in the same bank. This is what I was explaining. That what if people don't deposit the same money into that same bank? Then it means the process has to stop. The other one, we can talk about the process of credit creation keeps on reducing. We said if you try to look at this, you are seeing that this amount is reducing. So what does that mean? That if it reaches zero, of course you're supposed to stop there. Since it is at a diminishing rate, it means it is also affecting us because it is reducing to zero, which limits the process, because if it was upgrading, if at all it was going upward, you could be making, at least from one customer, we could be making a lot of money. Okay. The other one is high level of liquidity preference. High level of liquidity preference by individuals. For them, they want money instead of depositing the money into the bank. They want to be having they want to be having their cash. Then the other one is high interest rates charged by commercial banks, which discourages borrowers. And when they are discouraged, it means even the process of credit creation will not be continued. The other one is a lack of, limited number of banking institutions in developing countries. They are not distributed, they are just within central areas, and they are very few. Whereby, if they are very few, it means the rest of the areas cannot deposit money, so that even the credit creation process will not proceed. Because if there is no those initial deposits, people depositing money into the bank, then they will not start that creating credit. Then the other one is ignorance of the public about the availability, the available loanable funds in the commercial banks. People have no idea that the money is there. What they only know is that they're just biased, because even if you try to do a survey, you find that people are very biased about banks. Whenever you talk about banks, someone is having a very negative mindset of people taking their properties and whatever, banks taking properties. So that limits also credit creation. Let's go to the dilemmas I was talking about. These dilemmas that are faced by commercial banks within their lending policy is one. Let's try to look at how they come. The commercial banks is usually faced with the problem of achieving the objective of profitability. The objectives of profitability, liquidity, and security simultaneously, because they are supposed to achieve all of them simultaneous at the same time. If it increases lending so as to earn more profits, it will not meet customers' demand, that is liquidity. Because if you keep lending out the money you have, you will not be having enough cash reserve, money in the reserve that is supposed to be used by customers when they want their money. That's a problem. That if they want to increase lending so that they can earn more profits, they end up not meeting the customers' demands. That's the liquidity preference. On the other hand, if at all they maintain liquidity preference and they be having the money for their customer, they will not earn profits. So as there will be no loanable funds in order to minimize these conflicts, the commercial banks has to do the following. We say that one, when these banks wants to keep or give out more money, they will be left with less cash that will be needed by the customers. And if they don't do so, if they don't lend out, they will not earn profit, because they will not be giving out loans, but they will maximize the demands of their customers by making the money available. So let's try to look at some of these. We are saying that for profitability, if the banks want to achieve the profitability, one, they have to be giving out less interest rates on deposits or to depositors. And this is where the characteristics of banking financial institutions, intermediaries, comes in, whereby they give less interest to depositors. They are giving less interest, but they are charging high interest rate on borrowers. People who are borrowing, you charge them highly, but those who are depositing, you pay them less interest. This is the only way they can get the profitability. Then the other one is undertaking short-term and medium-term commercial investments. That's why banking financial intermediaries, they offer less risky investments and they are normally short-term basis. It comes from here. They want to maximize profit. The other one is charging commission for the services rendered to the customers. You just find that if you keep the money with the bank, when you try to withdraw the money from the bank, they charge you for ATM machine and whatever, ATM services and others. Those charges they put on you, they act as income to them, because to the person who is withdrawing, it is an expense, but to them, it is an income because they are remaining with the money. Then the other one is investment in government securities. When they invest in those securities, they will be able to earn some profit, because at the end of the day, when they buy them, when they sell them back, they will be getting something. Of course, you can't sell at a loss. Then the last one is discounting bill of exchange. For those who don't know the bill of exchange, it's a document that is received by a person, or it is one of the modes of payment. Someone can give you a bill of exchange. When he gives a bill of exchange, let's say of 10 million, if the person is settling a debt or is paying someone, he gives a bill of exchange of 10 million. What the banker does, if at all it wants to get this profit, it's by discounting this bill of exchange. How do they discount this bill of exchange? If the bill of exchange was 10 million, they give you 9 million or 95 million. Sorry, 9.5. When they give you 9.5, they remain with a difference of 100 or 500,000. And that 500,000 becomes their interest. What happens with this bill of exchange? When someone signs, it's like a check. Someone signs that document and provides it to you for payment, but it's upon maturity, that's when you are supposed to get the money. So what happens if the person who was the person who was paid, if he wants to get that money earlier before the maturity, you take it to the bank and they give you the money. But what the banker does, they give you less than the value or the face value of the bill of exchange, so that they can also be able to make profit. Hope you've gotten that. We got the next one, and we see how we can handle liquidity. This is for liquidity, and liquidity means making money available to customers when they want it. First of all, what the bank has to do is lending out money in phases, such that all the time there is money, there is some money to meet the needs of the customers. Because if you are lending out, you make sure that at least you give them in, if let's say in 1 month, you budget on the amount that is there, and you see how much you are going to be giving every month or 1 year, depending on the demands of your customers. Then the other one is lending out money on short-term basis. When you lend out money on short-term basis, we expect that you are going to be receiving that money in a very short period of time. So by the time the customers need their money, the money will be available. The other one is purchasing short-term assets. And we said those short-term assets, those are the government securities and bonds that can be easily converted into cash when is needed. The other one is receiving more deposits from customers. Of course, when you receive more deposits from customers, it doesn't mean that all the people who are depositing money into the bank, they will come at the same time to pick the money. Some will come at this date, the other one will come at this date. It means you will be having a lot of money that you can be able to pay those who want to pick the money. And since they are not coming at the same date, it means they are going to be withdrawing the money at a different pace. So that's how these banks are operating. Then the other one, you can talk about borrowing from the central bank. They can borrow money from the central bank. They make sure that if people need the money, at least the money is available. They can get the money from the central bank. Then the third last, we can talk about keeping some of the deposits with the central bank. There is a problem whereby when you keep too much cash, remember people want it, they want to withdraw the money. So by not keeping too much cash, because keeping too much cash and stock, or the disadvantages of keeping the storage costs are going to be high, whatever. There are so many costs that are happening. So what they do, they just keep some of the deposit money into the central bank. And we said the central bank is the bank to commercial banks. Hope you can remember that. Then the last one is regular withdrawal. They regulated the withdrawals. They may say that, yes, we allow you to withdraw the money, but you are not supposed to exceed this amount. That's why you find that these ATM cards, they have limits. You can't withdraw about 5 million. You can't withdraw about 7 million. It depends, but you can adjust. That's how it is. You find that those credit cards, they have limits. So the ATM cards. Then the other one is encouraging borrowers to deposit collateral securities. Of course, when they put collateral securities, whenever they get stuck and they don't pay the money, the bank can just sell off and get cash for other customers. Then the last dilemma is about security. Of course, when you have too much cash, people are going to steal that money. Not even the outsiders, but even the bank officials themselves. So what you have to do, first of all, you have to be having an internal control system within, a very strong one that can be able to detect everything that may happen within. Having catered for the people who are within, then you have to be having armed people to keep the building safe or the bank premises safe. Then the last one is to make sure that those banks, they are in places that own buildings which are very strong, so that you don't expect that the building is destroyed and people have lost their money. Because what happens is that this Uganda has a very, very, very poor credit protection policy. They only refund only 10 million. That's maybe if they have changed, but I don't think they are trying to change it, but it's really bad. You can't tell someone that the person has kept 30 million into the bank, but if anything happens, for the protection policy is only refunding back only 10 million. That one also scares people from joining the banks, because you find that someone can be having so many accounts because he knows that if I put over 20 million and the money gets lost, I will be refunded only 10 million. That's as per the credit protection policy. So you have to, those are some of the things that scare away the people to use the bank, and they prefer to hold their money in cash form. Okay, let's look at some of the problems that are affecting banks in developing countries. Problems that are affecting developing commercial banks in developing countries. We have unfavorable government policies. If at all the central banks try to fix a very high interest rate or a very high bank rate, which scares away these borrowers. Then the other one, high level of economic instabilities, inflation, changes in the exchange rate. People, when you see that the level of inflation is high, the prices are high, don't expect that people are going to make investments. They don't get investment, and they are not going to invest. They are not even going to save the money. So when they are not doing so, then the business of banking will be at risk. The low level of technology. This low level of technology is used because you know when you're dealing with the banks, they mainly use machines. That if at all the technology is very poor, we expect that they are not going to be having the safety of people's money. So by not having that technology, which is a bit developed or an advanced technology, they will be forced to import modern technologies, which will increase the cost of operation. When the cost of operation are increasing, of course, you know that from the cost component, you just know that the costs are going to be transferred to to the people who are going to be depositing the money to the bank, so that they incur those charges. So it becomes expensive. When the cost of operation is high, it limits their operations. The other one is poor and inadequate infrastructures, especially in rural areas. You find that people want at least to be using the banking financial institution, the banking services, but the transport network, the communication network, they are poor. They cannot facilitate the operations of those banks, which are highly mechanized. Then the other one is high-level political instabilities. Of course, you can't even open any branch in a place which is always at a risk of wars and others. Then high-level poverty. Of course, this is especially in Africa, in developing countries. You find that people are very poor, that to the extent they cannot even save. If at all they can't save, then how are you going to be getting these deposits we are talking about? That's a challenge. Then they will have high level of corruption and embezzlement by bank officials. You find that the bank is trying to strive to improve, but the people within, they are stealing the money. Then we have limited number of credit worth customers. That's a challenge. Why? Because they don't have collateral securities. When someone is poor, you expect that person to get where do that person get the collateral security that is going to be used to guarantee the provision of the financial assistance. Then the last one we can talk about the negativity, the negative attitude by the public towards banking. That's when I spoke about it. So we can proceed to the last one, and we'll try to look at what are some of the positive laws or the implications of foreign commercial banks in developing countries. These ones we are talking about, the ones which are coming from abroad and they are doing the operations within the country. And we are trying to look at their positive laws. What are some of the advantages of these foreign commercial banks? One of them, they are source of employment. They create employment opportunities to the local population by giving people jobs, those who are working credit office, the credit officers, bank accountants, and others. Secondly, they are source of government revenue through taxation, because when they make profits, we tax their profit and we get revenue that can be used to develop, to do the recurring and the development, the capital expenditures of the government. Then they facilitate development of economic and social and economic infrastructures in form of roads, hence economic growth and development. Here we are talking about the roads, the communication networks, because where banks are operating, you find that at least the electricity is there, because banks cannot operate when the electricity is not there, when the roads are very poor. So they try to at least make the government to at least modernize some of the places where they can install their systems. Then they promote technological transfer. We said that since they use a lot of machines which are imported from abroad, it means that they are going to bring in a new technology that will help the country to develop in form of technological transfer from the developed countries to developing countries. The other one is they promote the exploitation and utilization of the idle resources. How do they do that? By providing financial assistance to the investors that are going to be engaged in operations. The other one, they promote international relationship. Remember, they have come from abroad or from different countries. So it means we are going to be having a good relationship with the country where these banks are originating from. The second last, we can talk about the capital, the capital inflows. They increase the capital inflow. Of course, by bringing in their investment, already they are adding value, or they are adding income to the company, or sorry, to the economy, hence leading to economic growth and development. They help to facilitate the promotion of international trade. They promote international trade. How do they do that? By providing exchange rates, foreign exchange and money transfer services. And those are mainly used in international trade, because in international trade, we expect that we are going to be having different currencies which needs to be converted each and every time we make transactions. Then we can try to look at the negative roles. What are the negative implications of these foreign commercial banks in developing countries? One of them, we are saying that they accelerate regional inequalities in the economy, because their activities are mainly based in urban areas. Why are they based in urban areas? Is because of good infrastructure that is there, which leads to rural areas to remain undeveloped. The other one is they lead to profit repatriation. They take back the profit they have made within the country instead of reinvesting it back. When they make the profit, they take it to their mother countries and leaving the country of operation poor. The other one, they encourage rural urban migration. Since they are urban based, they encourage people to come to urban areas, which will increase the population in that area as a result of people searching for jobs and other social networks that are being provided within the urban areas. The other one, they limit the implementation of monetary policies. This one, we spoke about it. We say that these 5 foreign banks, they are just guided by the central bank, but they are not fully controlled by the commercial banks when they are executing their activities. Then the second last, we can talk about they undermine the provision of banking services to smaller local investors. Of course, when they come in, they just want to get those big fish, big deals. The companies which are already developed, they are the ones giving, because for them, they are sure that they will be getting their money very fast than developing these local investors. Then last one, we can talk about unemployment. It leads unemployment in a sense that these companies, when they are coming in, they bring in their people that are going to be working, especially in the managerial positions, than employing the people within the area of operation. And that becomes a challenge to them. Thank you for watching. Let's try to see how we can going to be linking up in the next video, and we talk about the international trade. We see how we can be able to pursue this economic environment, and we'll be able to understand it very well. And I kindly request you guys to subscribe. If at all you have benefited, make sure you subscribe, because it's not about getting the knowledge and you disappear. Make sure you subscribe. You help the channel to grow, and you share this information so that what you've got, at least another person can have a share of what you have acquired. Thank you.